Good afternoon and welcome to NYFP. The countdown to the Fed announcement on Wednesday has begun. Joining me this afternoon is Brian Barnier of ValueBridge Advisors, and he'll give us a better idea of what to expect on Wednesday afternoon. Brian, good afternoon. Thanks for joining.
Glad to be here.
Well, the countdown has begun to the Fed rate announcement on Wednesday afternoon. Not only do we get the Fed rate decision, but we get the Fed forecast and, of course, Ben Bernanke's press conference. So because there's been so much anticipation and talk about the timing of the tapering, how should investors as well as market players interpret those comments?
So there's a couple things to look for. The first is realize there's substantive, as you just mentioned, as well as a communication piece, and the chairman has urged that over and over again. Remember, he's a student of history, teaches history, and he's making history right now. So he's trying to drive confidence in the economy, not just QE. The second thing is to be very clear about this tension between data points and the dynamic economy and to understand how they go together.
And Brian, speaking of data points, we know that the FOMC has outlined those targets in terms of unemployment rate at 6.5% and an inflation target of 2%. But what other economic data are you looking at?
Well, I'm trying to look at the same kind of data that they're looking at, because he's made several occasions where, while those are in the headlines, he's talked about they're looking at the bigger picture of what's going on. So, for example, consider the personal consumption expenditures. You know, they've been doing nicely, moving along, but if you take apart that data, you find that some of that is defensive spending and some of that is what people are pushed into in healthcare and utilities and all that. So it's not all created equal. On the labor front, we just got wages data this morning, and one of the pieces I look at most is a manufacturing number, because that's supposed to be good jobs, right? Well, we've seen that drop a lot. It's come back up, and now the preliminary numbers for the last 2 months just released this morning are sort of flat. So is that sort of the uptrend or going back down, or where that's going to be? Critical number to look at.
And Brian, we need to differentiate between the economic data as well as the market data, just as we need to differentiate what's happening in the economy and in the market. So what are you looking at in terms of market data?
Right. So the bridge over into that piece is where we look at what are the returns to shareholders, financial assets, physical assets, stuff you buy, and labor. And the thing that we're seeing is great compression in labor and physical assets, and everything's plowing into earnings, as you see. But if you look at the top of the compensation piece to where we are today, that's dropped by over 6% since the first Q of 2008. And that's just pulling money out of the economy. And that's when we carry that piece back in and say, all right, so what's that doing to earnings? We go into the Zacks database and pull out some of their treasure trove. We look at analysts looking forward. From now, 12 months out, they're looking for revenue drop of 3% and yet earnings growth of 6%. So where's that 9% going to come from? Is that real productivity, or is there going to be some struggles in there? And if we look backwards at how well they did last year, we've seen downward revisions of almost 4% over the last 12 months. So there's a lot of data to think about.
And that is significant, but what are the implications of that?
So when we take a look at this, we've got to go back to those contrasts. It's not the data points, but it's this economic circulatory system that's out there. Think about it as an engine in your car. We're getting these sort of misfires of data points. We want to see a purring engine, and oh, by the way, while we're trying to get it to purring engine, somebody's draining gas out of the tank, the cash flow that's coming out of there and the investment overseas and the imports. So that's creating a bit of a struggle. In fact, the Fed needs to look at things a bit more like the retail investors that are watching this right now and think sort of long-term around life cycles of investments.
And Brian, last but not least, before we wrap it up, what do you expect to see in terms of Fed action?
Well, the thing that we like to see, I think, is going to be what we call Fed fracking. You know, we think about oil shale piece, but they've got to do some testing in the marketplace. They've been pumping a lot of water down there with the Fed QE, but the question is, where is the oil coming up, the real economic growth? And they got to punch a few holes in the asset bubble and see how the market reacts. So we're going to be seeing this back and forth dance as part of that communication piece that, again, the chairman is so fond of pushing.
Well, Brian, we have about 24 hours until the Fed rate announcement and the press conference, so these are very important points to consider. So thanks for your analysis and thanks for weighing in on this topic.
You're most welcome.